Volatile or volatility, it's a term that can be used in many respects. In the case of a substance, say acetone or ethanol, it's used to describe something that evaporates relatively quickly at low temperatures. In the case of a person, it's used to describe somebody who has a short temper. And in the stock market, it's used when a stock or the market as a whole is moving sharply in either direction. The thing is, it is also used as a measure of risk in your investment portfolio. They say that if volatility is high and it's described with standard deviation, then you have too much risk. The question that I'm asking today is whether that is an appropriate understanding of risk in your portfolio and how you should read it. What should your approach be when you look at your portfolio? Because ultimately, volatility is not necessarily a bad thing. You actually need a certain amount of volatility for you to make money in the equity markets. How should you use it to your advantage? That's the question I'm asking today on Moneywise. Joining me in studio is Santosh Joseph. Santosh, thanks so much for taking the time. I've never been
Alex.
called a volatile individual, but then I've heard volatility a lot. In the equity markets, there is a measure called the VIX, the volatility index. In your portfolios, mutual funds, and particularly, you look at a mutual fund scheme and its standard deviation, which is how much it has fallen or risen over a period of time compared with its long period average or the compounded annual growth rate. Is this appropriate when you say that this is the value of risk in your portfolio?
See, volatility measured in standard deviation is just an indicator.
Yeah.
Now, if you pay too much attention to it, then you'll miss out the bigger picture of why you're investing. So the standard deviation helps you understand how is the degree of variability of the returns of the instrument. It could be the fund or it could even be the stock.
Say that again.
It's the degree of variability of performance.
Degree of variability of performance.
So let me break it down further.
Sure.
You're going on a flat road, right? Or maybe let's take the metro. It's on flat surfaces. You can travel at any speed, fast or slow, but it's just going on a straight line.
Sure.
The same experience at the same speed, if I put you on a roller coaster, the experience is tangentially different.
Yeah.
Now, the speed here doesn't matter. What matters is the ups and the downs. Now, if the ups and downs are there, then the speed accentuates the ups and the downs. So volatility is actually telling you what is the variation that you're going to go through, both in the ups and the downs. Now, does that mean it's standalone risk? It's not. And if you also look at it a little more deeply, it is an indicator and not necessarily a cutoff to invest or not to invest, because sometimes you'll realize that that may give you an entry point. And if you're an investor, if you're going to be a consistent and a long-term investor, this entire concept of volatility becomes your friend. And that's why I like to say volatility is your friend. Maybe not with another human, but with investments, it's a great advantage.
So give me instances. Like, for example, even if you look at the market right now, volatility is relatively low as compared with long period average, certainly. And if you compare it with certain time frames where it's risen to, and I'm talking about the volatility index, which has risen to 20 or above, right now it's at sub 12, if I'm not mistaken. So you've seen a period where the equity markets have been in a pretty tight range. The question I'm asking is that advantageous? Because if you think about it long term, say 3 years, 5 years, 7 years, 10 years down the line, then this is a great opportunity for you to accumulate more units of the same thing at a price that is appropriate. It may not be the most attractive valuations, but at least it's not a market that keeps rising.
So again, we say volatility is your friend. Let me further break that down and say that if there was no volatility, every purchase that you make is only going to be higher.
Yes.
Now, because there's volatility, you have the object purpose that where you can buy it lower. Second thing is, just imagine if you're the one who's collecting units or the number of shares, every time there's volatility and you buy more, we know rupee cost averaging is happening, and also you're collecting more number of units. Now, when the price is just going one way up, generally there's a propensity not to buy more because the price is going up. You're enjoying the benefit of it riding up. But if you have conviction either in the fund or in a particular stock and your objective is to collect more number of units, then the volatility helps you buy more. It's literally increasing your purchasing power. Now, if there was no volatility, your purchasing power won't increase. That is to get more units or more number of shares. So that's why I say it's your friend. It will happen time and again, sometimes at a greater variation, sometimes at lesser variation. And that's why the people who are seasoned long-term investors appreciate volatility.
Okay, so, but then the question that I have for you is, why is it that people, particularly when they're speaking to relatively new investors, speak about standard deviation or speak about volatility and speak about risk in the same breath? Based on what you're saying, that's not appropriate.
You're right. So for many investors, the reason they see this as risk is when you made an investment and the investment dips below the initial investment value, they get a little bit worried. Now, let's take this as example. If you got conviction and you invested, if the price dips, it's actually not risk. It's an opportunity to buy more, and you're going to keep it for some time. Now, when the people have a fear that when the investment value dips a little bit, there is a fear of loss or a fear of failure, which is as powerful as fear of missing out, FOMO. Now, when people have a fear of loss or fear of failure, that's when they term this as risk. On the contrary, if you're convinced and you know you're going to be holding this asset and you're convinced that what you bought was right, if you get it cheaper, you're going to buy more and you're going to hold for longer. So therefore, for the person who's starting to invest off, who's yet learning the ropes of being a consistent long-term investor and understanding how volatility works, it's seen as risk. But the minute you graduate from that level and realize that every volatile patch that you go through is an opportunity to double down on your conviction and buy more, then it changes from being just risk to an opportunity.
Okay, so let's then ask you the next question, which is, and we'll circle back to this in a bit to use it, as you've said, as a friend. But how do you then judge risk in your portfolio, right? Because there is risk of loss of capital. And if there is no risk of loss of capital, then there is no potential significant gain of capital either, which is why the saying is no risk, no reward, or high risk, high reward, right?
See, I think traditionally we should understand that equities or the investments that we make a lot of money on are called actually risk assets.
Yes.
Now, the reason we call them risk asset is it also has got a underlying return potential which is far greater than the risk-free rate. Now, even standard deviation is measured.
What is this risk-free rate?
The risk-free rate is the return that you would normally make without taking any risk on the loss of capital.
And the example of that would be?
For example, today in India, our risk-free rate would be largely either the GSEC or the FD rate, which is when I put my money there.
The government bond.
The government bond, or even FD, because in India, largely that's also kind of a guaranteed outcome.
So that's like about 6.5%, right?
Between 6 and 6.5% is what we normally call the risk-free rate. Now, the question is, in risky assets, are we going to make more than 6.5? So the answer is yes.
Yeah.
That's why we call them as risky, because even the 6.5% is not guaranteed. But the returns that you will make is definitely far greater than the 6.5% return. Therefore, the way you look at it and the way you approach it actually solves much of your problem, and then you don't worry about volatility, because if something is not giving you 6.5 but going to give you much more than 6.5, if ever there was a dip, then, you know, just 2 and 2 makes 4, that you realize that, okay, I'm getting an opportunity here to buy something which is a risky asset, but it's got the potential to give me a higher than risk-free rate.
Is the time frame important here? Because ultimately you should be, as you're pointing out, and here we're talking about equity versus maybe a government bond, a fixed deposit, right? Because by nature, equity has more volatility. There is potential that if you're holding for a year, you could lose capital. And so therefore, what you need the money for, you don't have enough money for, effectively. And so, as you pointed out, if you hold for slightly longer, there will be opportunities in this time frame, say 3 years or 5 years, ideally, where that volatility and that fall in the prices will give you the best opportunity to buy more.
That's absolutely true. What you just said summarizes that when you're buying, when the fall happens, you actually not only recover, not only average, but you will also make more. But coming to the point of time,
yeah,
let's assume that we were rushing to the airport. Now, we are definitely going to get to the airport at, let's say, a given time. But if you have lesser time, risk increases because you're now worried whether you will make it or you won't make it. But if you have no quantity of time, you're going to comfortably reach the airport, then you have no risk. It's a very uneventful journey. Likewise, that's why anytime when you make an investment, you're asked to tie down the investment to the goal or the time. Because the goal or the time, in essence, tells you, hey, listen, don't worry about the variability of return. Your end will justify the means that you're taking. Because more often than not, why do people drop ship or drop their investments at the sight of the first level of risk that they experience? Is because they're not sure. The minute you know your time frame, the minute you know what is the goal, you don't worry about volatility. That's when you have the courage to go and buy more, and you will come to the outcome where either you'll average or you'll buy cheaper.
So then, let me ask the question again. How do you measure or identify risk in your portfolio?
Good point. See, we have already the standard deviation there. Some people even look at the beta. Now, standard deviation is to tell you the variability of return. Beta will tell you the sensitivity of your investment against the broader market.
So explain.
Okay.
In a scenario, let's talk about an example.
Okay. By and large, the fundamental reason we invest is we want to make money, and we want to make more than risk-free rate. So we discussed the 6 to 6.5% being risk-free rate. Now, when you look at the beta, you're saying, I've invested in a security, maybe a mutual fund, maybe a stock. What is my investment outcome there against the market in general? For example, today we had a good day in the market. Market gave you, let's say, a percentage return. Did you do more than 1 or did you do less than 1? Now, if you did more than 1, that means your beta is that it's capped. If your beta is 1, that means you did just the market. If the beta is 1.1, you did more than what the market did. But if your beta is 0.9, you'll do less than what the market did. The same applies when the market falls. If the beta is 0.9, you will fall lesser than the market. Mind you, even that is return. Losses not incurred also is a gain. Similarly, if the market went up and the beta is 0.9, you will make that much lesser return. Now, standard deviation is not connected to the market, but it's connected to the variability of return. One is the sensitivity to the market, the other one is the variability of the return within the sphere of your investing. Now, our goal is to beat the market, try and do better. Our goal is also to have lesser variability in return, because what happens is the degree of risk is used to measure so that you have conviction to stay the course in an investment, because we are believing that over time this investment will make money. Question is, do you have the courage to stay through the time?
So, okay, so then would you say that a standard deviation is better used to compare two instruments in the same bucket? To say, for example, in an equity mutual fund, let's take a flexi cap fund, to say that a Parag Parikh flexi cap fund has lower standard deviation compared with another flexi cap fund in the same category, but achieves similar returns. So I'm better off going with a fund that gives me the return that I desire, or maybe even better than what I desire, at a lower standard deviation. Is that the way to look at it?
Absolutely. You're right in the question itself, that when you have 2-3 funds in the similar peer group or the similar category, that's when standard deviation becomes essential. You got 2-3 funds. So the standard question is asked, there are 2-3 funds all given the same or similar return. Then what is the measure that you use to figure out how to arrive at selecting one or two of the funds into your individual portfolio? That's when standard deviation becomes extremely helpful. So you got one at standard deviation, let's say at 20, another at standard deviation 15. And if the returns are by and large similar, I will take the one with 15, because then I will go through lesser variability of return. Because the one with a higher variability return will not make me comfortable through the journey. The one with the lower variability return, not only will it make me comfortable during the journey, it's going to give me the same outcome. So building a portfolio with lesser standard deviation is great. Now, at a larger portfolio construct, when you put different portfolios, the outcome why people tell you to diversify, do asset allocation, is interestingly to reduce standard deviation. So the minute you put equity, fixed income, commodities, what you are essentially doing is reducing standard deviation, because assets perform differently over different points of time. And actually at a portfolio level, standard deviation makes far greater sense than just an individual security level.
Okay. Let me ask you this then. We spoke about the same return profile and higher or lower standard deviation. But what if a particular mutual fund scheme is taking a more aggressive route and so therefore seeing more volatility, but is giving you 5 percentage points more, or is significantly beating the category average, what should make you decide to choose this over that? And this may be true for a lot of sectoral funds, right? Where you might have a significant standard deviation, but in any given year, Santosh, you will have a sectoral or thematic mutual fund scheme that is top of the charts.
Off the charts, actually. So this happens regularly, and therefore if you notice that any diversified fund is actually a combination of 10 to 12 sectors.
Yes.
It's very evident over there. In fact, I'm of the belief that even though today sectoral and thematic have become very big in the marketplace, there is no express need to play a particular theme or a particular sector standalone unless you have deep double down conviction, because in a diversified fund they're captured well. You have allocation, therefore it reduces your standard deviation. Now in this context that we are speaking over here, the selection of securities should actually eventually help you drop the standard deviation, because even if the fund is aggressive, even if it gives you higher return, the question is what are you doing to invest? If you're an SIP investor, or if you're doing a systematic transfer plan, or if you're going to be a long-term investor, then you don't mind that high standard deviation at a particular fund, because you are very clear right now the standard deviation alone doesn't make or break my choice. But I will maybe select a high standard deviation because I'm going to be a systematic and a consistent investor. It changes. The stuff that you feared now becomes your best friend.
And a high standard deviation does not necessarily equate to a higher return profile, right?
Definitely no. So high standard deviation tells you the degree of variability. Remember, you could also get caught in the lower end of the spectrum within that. Therefore, the general stance for people is go with something which is predictable, then even though you get extra return but little less predictable. We don't like that uncertainty. So uncertainty is now categorized as volatility, and volatility, you're willing to take lesser return than take higher return, but uncertainty is what you don't like.
So now we're coming to the crux of it. You know that you need to take risk in order to get return, but relative risk you judge using tools like standard deviation, right? Or relative volatility or relative uncertainty, whatever you put it as, you judge using tools like standard deviation. Is there a space in your portfolio for for schemes or investments that could potentially have higher risk, higher volatility, but potentially higher return?
In fact, most portfolios, we got the strategic part and we got the tactical part. Within
or the core and the satellite as it's called.
Yes, core and satellite. And within that, you notice that most of the people who you interview and even you meet on the place, if there's an aggressive fund, got a high standard deviation, they'll say, don't allocate more than 10 or 15%. What they're trying to say is that we need that extra return, but we do not need the extra risk. So if you keep 10 or 15%, you will get that extra return by the way of that exposure, but you don't want to put the whole portfolio at variability or risk.
Because ultimately you're trying to protect your downside.
Exactly.
In that, if there is a situation that you don't want to arise and the risk of whatever you thought could happen has happened, then your entire portfolio is not bearing the brunt of it.
Absolutely. So you must go back to the genesis of standard deviation. The reason we have standard deviation is it's not necessarily upside optimization, it's downside protection. So if you're coming into an asset class purely only with downside protection, then maybe standard deviation is a great measure. But then if you're going to be investing for the upside participation, and most of us come into risk assets because we want better than not only risk-free, but the peer group returns. So therefore you will realize then it's a good tool. It's an indicator, but then the indicator itself will not take you anywhere. It's also the choice that you make. It's also the way you build your portfolio.
Okay. So, and I understand that this entire conversation has been relatively theoretical, but my attempt has been, and to you, viewer, if you've listened to this point, for you to understand the theory behind constructing a portfolio if you're doing it yourself. And this is important even if you're getting advice, because you know the right questions to ask. And so I do want to ask the next part, which is, we've spoken about volatility in that you can have volatility if you're rising very quickly, if you're falling very quickly as well. But there are measures to tell you whether you're falling less or more than the market and whether you're rising less or more than the market. You talked about beta, but there are more measures in a mutual fund portfolio, and you have downside capture ratio and upside capture ratio. So you've talked about standard deviation, you've talked about beta. Where do these two metrics fit?
So when you are finding it difficult to choose between standard deviation and beta, and for many investors, I know this is not an easy decision to make. But one of the things that is now publicly available in many domains is, how is your fund doing with respect to the upside and downside? So let's break it down. The upside capture ratios, when the fund is doing well, how much of the market's return has it captured in the fund? Similarly, when it's going down, how much is the participation in the negative rate? For example, if the market fell 10%, did your fund or security fall more than 10% or less than 10%? Now, similarly, when the market gave you a 10% positive return, did you just make 10 or 11 or 12? Now, for many investors, that's a good enough indicator, and not only for one patch of time. You'll have to see this over maybe 1 year, 2 year, 3 year. And it's very
1 year seems like a very short time frame.
1 year is very short, but I'll tell you what happens is that today you have many investors, for them, they look at the immediate past 1 year return to make a judgment for their fresh investment.
Which is not correct.
Which is not correct, but the point is, I think we have to be honest that many people, when they look at a fund, the only measure they look at is what is a 1 year, 3 year, 5 year performance, and at some level they try to triangulate. If 1 year good and 5 year good, then I like the fund. If 1 year is good and 5 year is bad, then maybe you don't select.
But the danger of that is that in the entire time frame, you talked about variability of return. It could well be that that moment in time is the worst possible time for that particular strategy, and the upside is what you want to continue and capture.
Well, that's the biggest reason why we're discussing this.
Exactly.
Because if you were to look at a 5 year, 10 year period and you got an upside more than 100%, you already have a winner at hand. Now, you have a long time frame and you have some fund which is captured consistently above 100%. That's the fund you want to be in with. And again, another fund that, okay, over a 5 or 10 year period is captured less than 100% of the downside ratio. You got a degree of comfort saying that if the market falls, I'll be protected. If the market goes up, I'll capture.
So far we've spoken primarily about equity mutual fund schemes, but I think a lot of our viewers would want to also understand how they should relate that to hybrid schemes in the mutual fund space, whose role effectively is to balance the portfolio. And in a very simplistic sense, when equity markets are high, they will reduce allocation to equity and move towards fixed income so that the downside is protected. If the market falls dramatically, they will increase allocation to equity. In multi-asset funds, they will also look at assets like gold, etc. So is it normal to assume that the volatility in these schemes should be significantly lower than equity?
Yes, you're absolutely right. So even within the hybrid schemes, right, you have the ones that are conservative and there are ones that are aggressive. In the conservative hybrid schemes, equity and fixed income will be well balanced and there'll be a dynamic formula that they do that. But the primary objective of the fund manager or the scheme will be to maximize the downside protection. Right? Their logic is that the fixed income bit will give its income and accrual and the equity will do its bit. I have to protect a sharp downside or a downside which the investor can manage. In the aggressive hybrids, there they play to capture at least 105 to 110% of the upside and a little bit downside protection. Because I think they have very clearly positioned the fund for the type of investor that comes into the fund. That's why it's always time and again kind of repeated saying that please know the fund that you're getting into, because even in hybrids, even in like a balanced advantage or even in like an equity savings, there are guys who are positioned aggressively and there are guys who are positioned conservatively. The conservative one is on capital protection, the aggressive one is little low on the capital protection, but they want to capture the upside.
The last point, it's said quite often, and I don't necessarily think this is appropriate, that time and consistency is the foil or counter to a bad selection. Is that true or is it not? In the context of what we've spoken, can you invest in a scheme with a high degree of volatility and not necessarily the best performance and still get fantastic returns or outcomes over a very long period of time?
First, a bad selection can never be made good, whether it's time or degree of variability. I think you should do a good selection. But, time and again we've realized, if you look at today's good performers, even on a 5 year basis, right? Or 10-year basis. If you went back 5 or 10 years ago, that fund would have not figured in your list of actually selecting that.
The rotation
fund,
takes place.
because the rotation happens. Therefore, as long as you are reasonably sound in your selection approach, you have to be okay with the degree of volatility. So what we are trying to say is that we may not always be able to pick winners ahead of schedule, but we can pick good quality instruments and let them ride. Could be highs, could be lows. Eventually you will make money because of good quality selection. So in risk or in time, quality is never a compromise.
So basically increase the probability that the selection that you have made will spend a little more time under the sun.
Absolutely.
Shall we say?
Absolutely.
Okay. On that note, I think Santosh, you wanted to make a point?
No, I'm saying this is almost like saying, how do I bulletproof my portfolio? When you make a good investment and you leave it, that's when it gives you the luxury to hold the portfolio for much longer, not worry about the volatile or the variability of the fund. That's where the most amount of money is made.
Absolutely. Thanks. On that note, for joining me and pleasure having you. This conversation, I must admit, was a little technical, but I think that it's geared to getting you to understand the procedure to construct a portfolio in more detail. Thanks so much for listening in. This is NDTV Profit.